2 shows in a row where TK is late, which I assure you is more the case than me ever being late. This I can tell you. It looks like Mr. Butler has finally decided to join us, but he's on location. What? I knew you were going to ruin it. I knew it. Not only were you late, you ruined everything. Where are you? Are you really in Calgary? Is that why you're so late? Oh, great. What a true
Can you
pro.
hear me? Can you hear me now?
Thank you.
I just want to take a moment to acknowledge the passing of Queen Elizabeth.
Oh, no.
So she is the queen, and it's a big deal.
Was
the queen, so she was our queen, and I don't think this affects the real estate market in any way.
I put that tweet out, but I didn't get much of a reaction to it. But
what did you do? What did you say?
I just said, how does this affect the Toronto and Canadian real estate market?
You think so similar?
Yeah,
I haven't been on Twitter today.
No, you have not.
But
it's well, there's got to be some kind of effect. What if like King Charles goes fucking bananas with all that power and money and starts like attacking Canada and like the rest of the Commonwealth?
I don't think they have enough power for that really to make a material difference. Like it would be different if it were like, the Communist Party of China was overthrown, or, there was some sort of coup in the United States or something like that. That would be a different story. But as far as, just changing a figurehead of the royal family, I don't think that affects the economy as much as people would think. But I'm really not the guy to ask. Let's be.
I got no one else, TK.
That, right?
I got no one else here.
Please get your information from another source.
Well, we'll ask Peter when he joins us.
Let's see what he says.
Yeah. Seriously, I'm not kidding. I mean, what good is it being the king of England if like you can't really go bananas and attack everybody? Like, what's the point?
You want him to hit the red button. That's what you want.
I listen. If you can't, I want him to have the option.
Yeah.
Well, what's the point of being king then?
Well, let's go with another scenario that I think would have an impact on the markets, but you tell me which one. What if Donald Trump runs for the president again in the US and wins?
What happens to who?
The markets.
Same thing that happened last time, no?
What do you mean?
I don't know. It seemed to be pretty good for the economy when he was the president.
Vague answer. It was good for the economy. Yeah, I think the markets are going to spike.
How is the same thing that happened last time vague? Like it's actually
vague,
pretty detailed. I mean, it's the same. It's documented.
What do you think the weather's going to be like next weekend? It's probably going to be similar to one of the other weekends.
I didn't say similar. I said the same. Yeah. Anyways, I think this is irrelevant to everything. What is relevant though is interest rates went up a little bit again, and this is crazy, isn't it?
Well, regardless, let's talk to our guest and figure out what he's got to say.
Oh, he's got a lot to say.
Good.
Okay. We have to. Can you pronounce his last name?
If I can't read it in front of me,
I can't read it. Yeah.
Well, I don't know. I don't even know what his last name is.
Well, okay. That way to ruin the whole show again.
Show it to me, and I'll pronounce it.
It's in the invite. Kiriazopoulos, I think. Kiriazopoulos. Zopoulos.
Okay, first of all, your Greek accent's horrible.
Kiriazopoulos. Huh? What's Greek sound like even? Peter Kiriazopoulos.
Kiriazopoulos. I'm the best.
You're the best.
I'm the winner.
You definitely is the winner. Is that Swedish or something?
This episode is brought to you by Landlord. This landlord software is a game changer. You upload your properties, right? You'll upload all the information, income, expenses, timelines, mortgage details, everything that you need to have so that you keep track of everything in your portfolio. And as you go through real-time adjustments in, rent increases and water bills and tax bills and everything else, they're going to actually give you recommendations on how to make your portfolio more efficient. And it just breaks everything down for me in a way that I've never seen before. Like Excel spreadsheets just don't cut it. I don't think there's a better program or app out there for investors, and it's free.
Please click the link below for your free trial offer.
Are you Borat now?
Oh my God, was that like, could it be worse?
Yeah. Are you Kazakhstanian? Like, what's going on?
Not today.
Not
Look at
today.
this. Do we have Peter here? Hello. We're having too much fun, TK, for people that just got bombed by the Bank of Canada.
Am I in Calgary and you're in Toronto?
We're all over the place.
Okay.
Peter.
Well, there you have it.
We can hear you. We can hear you.
You can hear me.
And see
Welcome
you.
to the party.
All right, what's going on?
How you doing?
TK, I'm good. How are you guys doing?
Good.
Yeah, nice to meet you. Nice to meet you, Peter. How are you?
Yeah.
Good. All good, guys.
Good.
I feel like I know you. Like, I feel like we've been in those Twitter spaces like since day one together.
Pretty much.
Yeah.
That's
I feel like
it was great for Dan putting them all together. It's good. Like last night's one was a really good one. It was really solid. God. Had a lot of really good people in there. Guys with experience, some journalists. Ben was there. Some really smart people. It was it's always good when we get that hive mind going, right? And we get to bounce ideas off each other and our own experiences.
Yeah.
What were some of the topics?
Well, basically we discussed the Bank of Canada rate increase, what its effects are going to be, about trigger rates, renewals, lack of liquidity within the private, or tightening in within liquidity, looking at the private lending market as well as a sort of a secondary or as a backup for people who just can't get funding, or the people who coming up short on appraisals. That's the other one, right?
Mm-hmm.
There's always going to be that looking for that additional funds to bridge that gap for people when the bank says, hey, you know what, it's not worth what you bought it for.
And that those funds there are becoming in short supply.
I don't think so right now. As long as the numbers look good, like I won't get into too many specifics, but there was I deal with a lot of these mortgage brokers, but there was a private that they thought at the time was going to be a really good deal, and for whatever reason the guy needed it for a couple condos downtown. And appraisal came in and they were just north of what their accepted levels would be, what any accepted levels would be for any lender out there. And they passed them off to the market. They just wouldn't take them. And we're talking like prime downtown condos. And those rates for them jumped too, where they, you went up from maybe 9% total to 11 and 12. So
I think maybe I worded that wrong, because you're right. There is money out there, but the terms that have to be met in order to get access to that capital have changed dramatically.
Oh, significantly. Absolutely.
Yeah.
From like, I don't have I'm not the firsthand knowledge, but this is, just from my experience and talking to these guys. Like, I try and connect with them easily on a weekly basis just to see, what are you seeing in rates? What are you seeing in the market, especially on the private side, because that's sort of like the de facto, last line before you just give away the keys, right?
Yeah.
It's crazy because right now the price is almost secondary to the amount of money that people are going to pay every month. Like, the amount of interconnectedness between agent and mortgage broker right now must be like pretty intense. No, like, you guys have to figure out a way to get deals done that really shouldn't be done at the moment.
Well, I don't. If I see a deal that shouldn't be done, I'd rather.
No, but it's done already. No, but they're done already,
if
right?
It's done.
Well, it should not have been done.
Should not have been done. Maybe.
Yeah. You know what? The thing is, in general, yes. Personally, no. Like I'm in contact with them because I want to know what's going on behind the scenes for them. Like, I'm talking to them all the time. When it comes down to my clients and getting their deals, yeah, I'm always in contact with them. I want to know how things are going and how the deal's being funded. But In terms of trying to get it done, well, you know, we go in eyes wide open, knowing that, hey, like, prepare yourself for this, for every single, like, any potential pitfall that could arise. We want to prepare ourselves before we firm up or sign on the dotted line. So at least we're aware of it and we're not scrambling last minute, at least on my side with me and my team. But just, you know, they're dealing with a bunch of other agents that come towards them, and, you know, I see it and I hear about it, where it's like, this guy needs help. This guy's like, we need to move him over here, or, you know, try and reposition him into a different lender, or go private, or take him down to a B, you know, just, and then with that just comes higher rates.
So, but isn't this a really good opportunity for some private lenders that have a higher risk tolerance than most?
I would say so. Like, I invest my own funds, to be frank, in the private lending space, but I haven't touched anything in a year. I'm, you know, just under a year. But if someone's aggressive, someone says, hey, I don't care about an 80% loan to value in this market, and, you know, they want a 12, 13% return, well, it's there, you know. But at a certain point, someone's gonna, you know, you're gonna take a second at 14, 15%, like Mark, the lawyer, was saying last night. At a certain point, you got to say to yourself, is the rate so good because there's no way they're going to pay it back, right?
Yeah, why are you getting that rate,
well,
right?
You know,
why is this
usually,
rate
it's usually around that
being...
20% mark, right? But, you know, but at the end of the day, there are people out there that I've seen just flush with cash, and they're ready to deploy it. But it's, again, like you said, TK, it's got to be on their terms, right? So
yeah, and the mortgage business is designed to, you know, facilitate these transactions, right? So unfortunately, there are going to be people who have money who shouldn't be lending out private money, who shouldn't be in the business at all, who should be, you know, putting it somewhere else. But they're talking to a mortgage broker or a friend or somebody, and they're saying, no, you know, you can get these really great returns, and because none of the experienced guys wouldn't touch anything over 65% loan to value forever. And like these guys have been through the whatever that word is, to, you know, of all the market changes, right? So
right,
these guys know, and I would talk to them, and they'd give me all the, and I said, are you nuts? I can get 80% at, you know, 8% or whatever it was. But that was because they had experience. They said, no, there's a reason that you're coming to me, and I don't want to be stuck holding the bag at the end of the day. And, you know, there's lots of people who are carrying debt right now from the earlier part of this year, where if things don't go well, whoever's got that loan won't get all their money back. The property's not worth what.
Oh yeah, like you said, you took, even if you got conservative and you were in the greater Toronto area, like not in Toronto, but you took a 75, you said, hey, I'm going to be conservative and take 70-75% loan to value on a private, on a first. And well, I can tell you right now, even if the property's gone down 20%, your friction costs on a power of sale, I guess, are somewhere between 8 and 12%, just being conservative. So like, you better just hope that person continues to make the payments, and then you can get your money out and they find someone else at a higher rate to continue to carry that for the next term, the next year.
Yeah. What about trigger rates? Let me hear this topic. And maybe I'm not as educated as everybody in the Twitter space last night, but I am not afraid of trigger rates based on the information that I see out there, and that this is a very, very minuscule amount of people who will ever be affected by this in a great way. But enlighten me from the Twitter spaces yesterday.
Yeah, well, again, from my perspective, I don't think it's going to be a big deal, based on there's the letter of the law and the sort of the spirit of the law, I guess, in terms of how the banks implement it is going to be the main issue. I received a letter from the RBC, and publicly, when they send you to their website on how you can manage once you hit that trigger rate, like your easiest option is they give you the option of basically switching to a fixed, which I'm not a fan of, lump sum payment, or increasing your monthly payment by 10%. Well, that's not that big of a deal for the most part, right? If you're paying $2,000 a month and you move up to an extra $200 a month, that's not a big deal. TD, on the other hand, from what I read in this letter that was sent to me last night, And actually, Ben Rabideau posted the exact same tweet today that we're talking on how they're going to implement it. Is they're not going to do anything. If your LTV is less than 80%, they're just going to extend your amortizations, and they're not going to increase, from what I've been hearing. So like, if in the short term, I think it's not going to be a big deal for those people in those static variables, only because your cash flow will be affected at not at all or on a minimal basis. But on renewal, if you haven't been making additional payments and you had a 30-year amortization and you come up for renewal 5 years later and you're supposed to be at 25 years and you've just been riding this out, assuming rates stay flat, you're looking at north of 50 years. And then when they recalculate that back down to 25 or 30 years, then you're going to get sticker shock on your monthly payment, I think.
Do you think people,
I think it's renewals.
But do you think
renewals,
people look
100%. Yeah.
Do you think people look at their payments as like only for 25 years? They don't look at them as like forever. I'm going to be making, like, do people have this, like, there's this actual 25-year period in the future where I'm going to stop making payments or something?
It varies. Like, for me, all I care about is cash flow personally. Like, you want to pay off any debts you have, but on investment properties, the tenant does that for me, right? Ideally, you'd like to offset as much debt as possible, especially in a rising rate environment. But I don't think so. I think people just I don't think they think about 25 years down the road. I think about 2 months down the road.
I think they think at the 31st of the month.
Right. So most,
exactly.
How do I get to the end of the month? Yeah.
But most people, if they can keep their job and keep their income level, they can keep paying their bills. Maybe they get lucky. Like, are you a pivot guy or are you a doom and destruction kind of guy? Like, is this thing going to turn around and maybe we'll see 3.5% in a year from now?
Well, I am a doom and destruction guy only because once doom and destruction comes, I'm both actually. So the pivot comes when there's doom and destruction. They've got to be given a reason when you're seeing 7.5% inflation prints, and as of yesterday, 3.25% interest rates, short-term rates. They have to be given a reason to say, hey, we're going to get rates positive, right? Because technically real rates are negative at this point, right? So if the market can sustain 6% overnight rate, then why wouldn't they go there, right? Like, if you're sitting on cash too, that's a great thing. So, like, everyone thinks, because we're so heavily indebted in Canada, like, consumer debt is so high, I think it's like 105% debt to GDP or whatever. Like, no one thinks on the income side. Like, I can tell you now, all these old people I know sitting on cash, you're telling me a 1-year GIC at 4.5%? That sounds great when they were getting, less than 1 a few years ago. So from that perspective, even going back to the private side, why would you take a risk 2 years ago on a first at 6% or even 7% if you got lucky, when now you can just go to a GIC, lock up your money as a deposit, and pull in north of 4.5, maybe even 5 if you get lucky. So there's going to be people losing money on that side as well too. Like, liquidity will dry up on the fringes for those people who just like, look, for almost no risk, I can deposit my money at the bank and deal with it that way, right? But I forgot the second part of your question, Joe.
So did I. What about we talked about it yesterday. Like, what about VTBs coming from the sellers now to keep deals alive and to maybe keep their purchase price where they liked it?
Like I said, I haven't seen too many of them, although 2 did pop up directly.
Yeah, didn't you say that last night? Yeah.
So two agents sent me an email saying, hey, we're going back on market from earlier this year, and we are the seller will consider a VTB. Normally these are usually I see them just on land deals, right?
No, but
now
Mark,
anytime VTBs are offered.
Mark the lawyer said 5 times in the last couple of months he's seen it, and before that it was like 5 times.
Those are on firm deals. Yeah, we've seen a lot of those too. What Peter's talking to is going to market and offering a VTB in the GTA, And that just
Oh.
basically says, hey, we want more money than it's worth, but we'll make some sort of
Exactly.
arrangement
Sure.
with you.
Zero
so you
down.
Pay me more.
Yeah.
So
0%
I'll give you a
for
TV.
24
You want my
months.
couch, and you can drive my Corvette for like 3 weeks of the year. You know,
Let's ride this out together.
That's what it is.
Yeah.
Yeah, exactly. Actually, I had
Prices
one
will be
client who was
back.
gonna I almost had a client in the declining market. He threw in his swim spot that he ordered.
Nice.
into the deal.
20 plus grand. Yeah.
Yeah, exactly.
Yeah.
Anyways.
So those VTBs though, I think that Darryl's referring to, these are like last ditch efforts. I did them in 2017. I didn't have to do any this year. But I would have if it came down to that. Right. I know a couple guys that I work with who took price abatements. And so they said, you know, we'll take 50 grand less or whatever to be able to make this deal go through. Right. Based on all this stuff. The ones that I was dealing with in 2017 were like 6 figures. So they were big numbers. And it was like, there was no way to close this deal. The only option for that seller to ever have that money ever come. And I'll take 2 quick stories, would be through the VTB. One, that money's never been paid, by the way, but the guy's earned about 100 grand in interest. So he's kind of like, he's doing well, right? So even if they don't end up paying him, he's still going to be doing well. The other one, I brought this up recently to someone, is he wants his money back. And he's trying because he's nervous because it's a lot of money, and he's nervous about what the market's going to do. And, you know, based on the numbers, I mean, the guy's probably pretty close to underwater who owns the house, but as long as he makes those payments, he can stay there and everything's fine. Right. So they're dangerous, very dangerous. You never want to be there.
So, but now we're in an environment where you can actually make a condition, right? So you're getting conditions for 30, maybe 60, 45 days right now. But in that time period, like the house is losing value these days, the way things are going. And we just got a nice rate increase, which means something has to give, right? So like, is that not going to be something that people pull out of their back pocket more now? Because during that 30, 60 days, if the appraisal doesn't come in, but everybody likes the price and can afford the payments, and like, I don't know, things or things are going to really fall apart fast now, right? Because if there isn't something kind of keeping things elevated, which if people can't afford them, I mean, something has to give, interest rates or prices, right? Well, we all know interest rates aren't giving anytime soon. So it has to be prices, or the market just stops.
And prices are giving, but I don't think this initial rate hike is going to have an immediate effect on really anyone who just doesn't have a at this point almost any variable rate mortgage and a HELOC, right? That's where people are getting squeezed on that point. I just think people looking to make moves in this market right now are still either at rate holds, or, you know, they're not influenced by this by the rate sensitivity, like it's limited, so they're still making moves. I probably see seasonally, like for this September, we'll probably see decade lows at a minimum in terms of transactions, but for the most part, it's 6 months down the road that some of this stuff is going to be felt, right? Because even from current homeowners, only now have we had people start to get triggered, right? And the banks are not handling it as they in a way that would detriment the homeowner. They're just saying, okay, make your payments, we'll kick the can down the road. So even now, like, some of these rate rises aren't really potentially squeezing people unless you're, you know, with one of the banks that just has a floating payment, and your rate's gone up $800 to $1,000, or your payment's gone up an extra $800 to $1,000 a month. Those people are getting squeezed right now. Everyone else is pretty much okay for the most part.
Most of those people, right? Like, if you should be making sound financial decisions. So right now, if you're buying and you're planning on, you know, purchasing soon, because, you know, you have a need, you have a genuine need for it, you should have a rate held if you want fixed, right? Or you understand how the markets work with a variable rate. So you know already that, okay, whenever I buy, I'm going to be able to tolerate, because you're getting stress test at, you know, 6 to 7%, depending on what you're getting. And your rate payment is going to be based off of whatever that variable rate, overnight rate is at the time. So like, in your head, you kind of know, like, I can tolerate $1,000 fluctuation in this mortgage payment. That's why I'm going with a variable rate product, as opposed to trying to lock into something fixed, which is what, you know, you should have done in the past.
But
and
the
people
value is going down simultaneous to the payment going up.
I understand, but at the end of the day, you're going to eventually enter the market, and that will be a fixed point. So that principal amount is going to be a fixed point. So like you should just, people need to understand, I think, mortgage products more now than ever. I think that's, I guess, what my point is, especially those adjustable rates. You know, if you were taking on that, that should be like in your head, you know, that you can tolerate an increase in rates because you're betting on over the next 5 years, rates will come back down and that this will be a smart move for you, right?
Yeah. How many people like have trigger rates, but have just heard the term trigger rate for like the first time and are like, oh my God, I checked the mortgage and we got this trigger rate. We're like, we're fucked now. Great.
I've had 3 conversations this week. Clients just reached out to me, and you know, a couple of them asked about trigger rates, and the other one asked. I mentioned. He's like, "Oh, what's that?" And I was like, "Check your original documentation." I'm like, "Good thing you're with a bank that's, you know, that's really not going to do anything to your cash flow." But you know, but to the mortgage side, the other question I had is like, and I mentioned it last night. You know, you're fixed if prime's at 5.45 and they give you even a full 1% discount on prime, which I doubt the banks are doing right now, you're fixed and your variable pretty much the same at this point. So I'm curious which way people are going to lean to. On one hand, you know, like the delta's not there, so they're like, I can lock in a rate at what's going on now, but are people locking in at the peak as well?
Yeah.
And do they avoid
First time in ever that I remember the rates being almost identical, right? You've always like,
I think
from my
just
knowledge,
after,
I don't remember.
I think just after the first lockdown in 2020, I think if we looked at that point, fixed and variable were very tight, and then the spread just blew out where, you know, overnight lending rate just got chopped down and risk premiums got cut. But I think so.
But like
yeah, they were less than 1%. It was like, you know, when it got down to like 2% on a fixed, you were like, you know, in the low ones or something like that.
But it's so distorted where you can get a 1-year rate more expensive than a 1-year rate's more expensive than a 5-year rate right now, which is crazy.
Yeah. Interesting.
Yeah,
interesting times we're in, Darryl. Interesting. Good thing people have the Canadian Real Estate Show to watch. To be able to get all the facts from our great guests so that they know what's going on. Otherwise, they're going to be in trouble.
It's really a confusing time. Like it has to be. I mean, look, we all had 40 something years of just kind of basically up. A couple of blips along the way. Last time that there was a blip and the time before there was a blip, a lot of people were calling for the end of the world and doom and destruction. And this is the time they're going to bury us. And I mean, last time in 2017, when things started getting a little scary, rates went the other way pretty quickly, didn't they?
I think it was 2018 they started to cut, but I don't have it in front of me. I just pull it up.
I just always ask, and I don't think I'm right, or I don't even know what my opinion is, but like, why is this going to be the time that they just drop the hammer on everybody? Why is this the big Great Depression one?
The difference between all those other times, if we just go back 20 years, is CPI prints. Like there's actual concern for inflation for the most part, right? Like in the last decade, no one's talked about inflation. They were talking about disinflation. And they were talking about, oh, you know, boomers are going to age, they're going to spend less. You know, there's no replacement in terms of replacement and fertility level. People aren't having as much babies. You know, for whatever reason, we're talking disinflation, technology, demographics, the whole bit, right? And now I think they have political reign to say, hey, you know, who cares what happens to a certain degree to asset prices? We have political free reign. I don't care what anyone says. Bank of Canada is not independent from the government. They're talking all the time. And from my perspective, you know, to a certain extent, outside of whatever happens to asset prices, they have the ability to just raise rates and screw it, right? So I think that's what's changed. The fact that they have this mandate that they can say they're going to squash inflation by just crushing everything in their path.
So really the question is where do we see inflation in 12 months? That's really the
It's-
question.
It's
Because
really
rates
tough.
rates will be they'll be looking to drop rates, Daryl, and they're going to want to bring them back down to
That's what I'm
like
getting to.
neutral or below, right? You know, depending on like in a stimulative range, depending
we-
on where we are. But
Aren't
to
we in
Peter's
the
point,
neutral range now?
I would say so. Yeah.
we just crossed the neutral range, right? I think it's 2 to 3 is neutral, and then restrictive is anything over 3, right? Is that right?
Man, you know what? It's whatever they've been calling it. I figure right now we're probably in the form of neutral range, but I don't think it's a set number. It's just basically how the economy reacts to rates within, like you're saying, it's not stimulative, it's not destructive. You know, at that point, you need evidence for that. It's not just one set number, because there's
True.
there's other things that affect it on the outside, like existing debt levels and things along those lines, right? So, you know, and sensitivity to those rates, which I think is much higher than even
Higher than
40
ever
years
in
ago.
any community that's ever experienced rate
Well,
hikes. I mean,
because
we have so
last-
much debt here,
Well, in
government
the-
and public.
In the 80s, our debt to GDP was like in the 50 or 60%, and now we're like 128 or
It's
whatever,
doubled.
right? So,
Yeah.
but the
like household debt
government
is doubled.
Well, but the
then, I
government
think.
debt also has ballooned like similarly, if not more. And they're just as rate sensitive as anybody. I mean, imagine what the debt payments look like compared to a year ago, right?
Yeah, but aside from devaluing a currency, they, you know, they can make their own, they can print their own money. A really smart guy, Richard Diaz, just looked at 89% of the government debt was essentially bought by the Bank of Canada from Q2 of 2019 till now. Like that, like they've absorbed all that debt. So like, if it just sits on their books, who cares? Who are they? You know, it's not like they have a bank to pay, right? Like it's their own funds. We can't print, you know, Darryl bucks in your basement and then run
We've
up as
tried.
much debt.
We've tried. Yeah.
We've tried.
You know what I mean? So it's like
No one wanted
like,
them.
No.
You know,
Yeah.
government debt
I
is a little
did.
bit more stable and liquid than saying household debt. But you know, if we look at household debt in Canada, it's crazy high.
Well, let's look at what's led to inflation. What are all the factors that have led to us being right now in this inflationary period?
Oh my
I
God.
don't know.
There
That's
What
a
are
tough
they?
so
question.
many.
Supply chains, right?
I say it's a combination of supply chains for sure. Basically
Okay.
that friction within the logistics markets, and then a massive fiscal, like the difference between 08 and now. If we just take the US as an example, is 08 they just did quantitative easing and bailed out banks and just went out and started buying, I think it was just bonds, right? And now the difference is everyone got stimmies in the US and we got CERB, right? And you make this influx of actual cash that is stimulative to the economy, and that can cause inflation, especially when on the supply side, if we looked at Darryl, you're a builder, you look at lumber. Well, it takes the lumber mills a long time to ramp up production once they've been shut down for a couple months, but the demand is that snap your fingers, put an order in and say, hey, you know, I need a truck full of 2x4s, right? So that, you know, do that with, and give people the ability to do that with stimulus and government backed loans. So that's the other thing too. It wasn't just CERB that came out. It was everyone who had a corporation, a business that, you know, that met the criteria. They got 40, but then it turned into $60,000 in basically a government-backed loan that 20, like I think it was 20% of it forgivable, right?
And a lot of people that didn't
It's just a
actually
grant.
qualify got it. Like
Yeah,
probably
but it
more
was just-
people didn't qualify that got it than did qualify.
I know people who didn't need it and they just did it because it's like, look, the government's going to grant me
money,
20%. So I'm like, I'll just take this 20K. You
Yeah,
know what I mean?
smart
So
decision. I mean, at the end of the day.
I don't know anybody that would do that.
Government-backed loans plus disruptions in supply chains. That's probably, you know, I'm not an economist, I'm not in financial markets, so I just have an interest in it. But I would say that's your main impetus for inflation, and I think they're going about it all wrong. Like
So over demand, overbought products and services, right? So that's one. And then on the supply side, restricted supply chains, coming in. So that creates, again, an increase in prices. Probably a lot of sentiment too, right? Inflation's self-fulfilling, right? All of a sudden people start to say, well, it's inflation, you know, pay me more, I should charge more, I need to pay more because everybody's
Not
talking
enough
about it and stuff like
labor.
that.
Yeah.
Yeah.
For
But
sure,
I mean,
absolutely.
how long do those factors remain? Like, that's the thing. Like, how long before people
If
start
we
to get
knew, we
hit
wouldn't be
really
here.
hard? Yeah.
Well,
Right.
but
It's
there's
like,
also a lot of people that own companies that have the ability that when things are like this, they can squeeze a little bit more for themselves too under the conditions, right? So there's like this additional little bump that I guarantee you, like gigantic companies with almost monopolies are like, we could do whatever we want right now. And they're
right
not
now.
right now.
Yeah.
Well, in this environment, as things are going up, and they're also doing it to protect their bottom lines for later because they don't know, what's coming down the pipe.
When I've been surveying like business owners since all this has been going on, and very few have told me that they've seen a major increase in their cost other than the big industries like food service and, a few of the ones that we're dealing with, overseas type of stuff like shipping containers, like when
Yeah.
all those guys like martial arts equipment, furniture, whatever, they had these major shipping increases and stuff like that. But as far as any other businesses, when you would talk to them and say, how have things changed for you, for the most part, they weren't as affected.
No, they
Right.
were saying that they couldn't find good people, couldn't find enough
That
good
was,
people.
yeah. So maybe
Yeah, so
in that side, they have to pay more for their labor or something, right? Like that was their increase to their expenses.
gotcha, but that's not really inflationary. I think we're and again, I'm not an expert in this, but my own opinion is, I think it's just price increases as opposed to just inflation. Inflation's something else, right? It's like a monetary thing. So I think the biggest issue, the biggest aspect of this 8%, let's say, inflation print we saw is primarily supply disruptions and inability to get the capital or the supplies that people need when they wanted to, and I think they're handling it the wrong way personally, from my perspective, because
What does that mean? Elaborate.
so like again, so by increasing the cost of capital and just raising rates, well, you're killing they're trying to kill the demand side, but I've always thought that by doing so, they're killing aspects on the supply side. So if we look at housing, how many projects have been shuttered because of just rising costs when it comes to, let's say, financing and just the cost of capital? People are just shuttering stuff, right? It's brought prices down, but it's also hasn't given builders the motivation to build as well, right? And
so I think it'll affect the supply chains more on the housing side.
I don't know. I'm just it's just in my head, and if we look at someone named Mike Green, really smart guy, and I sort of side with him on this perspective. I think they're making a mistake by raising rates this quickly. Everyone just looks at the CPI and they're like, inflation's 8%. Well, interest rates need to be at 8%. And it's simple, like black and white for them, and I don't think that's it. And I'm not smart enough to know what is the answer, but I think like by just raising rates, you hurt the actual solutions needed to fix those problems, right? Like
You don't need to hit the same city with 2 atom bombs. Like you can hit them with 1 atom bomb and see what happens for a little bit, because there's an after effect, right? We didn't get any chance to see an after effect from anything. We saw the wind shift when they started talking about a 1/4 point increase. We saw like disruption all over the place,
No,
right?
we saw it before that, Darryl. Like
Even
especially
before
in housing,
that, yeah, really.
like
Actually,
January was like 200 showings per listing, and then it was like February it was
mid-February
60.
we tailed off. You could see it. We were talking about it. Yeah,
yeah, right.
absolutely.
It was doing.
listen. 4 months ago, variable rate mortgage was the savior for most people, and now it's like satanic to even think about it. It's stupid because you don't know if it goes another 50 points next time. Like imagine you started at 1.5, 1.8. Yeah, it's like, oh, how can you possibly like deal with it? It's
well, like I said, and people haven't even felt the full effects of some of these, right?
not even close.
Yeah, exactly. Like
it's like one nuke after the other, and it's like, stop, like I'm bleeding already. Like I'm dead.
Well, people like Benjamin Tull and other economists I listen to, they're like, a rate hike usually takes 12 to 18 months to feel the full effect of it, right? So like we've done 300 basis points at this point. Like I don't think we've felt
They're
the full
impatient.
effects.
They're like,
You
I
know,
want to
they're
see the
impatient.
results.
It's politically,
Give
yeah,
me,
it's
give me the
politically
results.
motivated. I think it's just
Yeah.
completely politically motivated. Like again, I harken back to what Mike Green says is like by raising the cost of capital, and you're hurting the supply side, or on the ability to make productive investment to fix those supply issues, right? Who, you know, and his solution is, and who knows if it's right, is talking about like if we say we're in wartime against all this COVID and whatever BS, then you know do COVID measures or do wartime measures, and it's just you're going to do a shit ton of fiscal spending to give people money to offset energy costs, right? That's what they're doing in Europe. So California is doing billions of dollars as well too. You know, and if it comes here, they'll probably do it because it's the most short-term, easiest solution for any politician. Just say, here's an extra $200 to pay for your energy costs, right? And
Yeah,
that's
while
what,
raising rates. It's like in Europe, it's like, hey, we're gonna
right.
they were
So
at
don't raise
zero
rates.
forever, right? We're gonna
But
raise rates 75 points and we're gonna give you some money. Like figure that
Oh,
one
and
out.
on top of that, they're buying the shittiest bonds to make sure that, you know, the Italian bond and the German bond spread isn't that far. Like they're still buying bonds, they're just not calling it quantitative easing. But like, just if you're going to spend all that money, not and just give it to consumers for short-term efforts. Do it to fix these long-term problems that we see within the market. But they're not, because you know they're by the time those problems are solved, their election cycle would have already passed.
Yeah.
And that's just my perspective. I don't know if I'm right. I don't know if I'm right. I don't know, but I think they're over. I think they're just over tightening personally right now, and I think they at some point they probably would need to pause. But that's just my guess. There's other people out there who will say, you know, 1% for the next year, every meeting, just go nuts, right?
Yeah.
And
I haven't met anybody who's A, predicted it correctly every single time, or B, has been able to like consistently provide a solution to any of this, right? There's just so many opinions. And I think that that's the reality is that same type of confusions happening at the Fed's office and the Bank of Canada's office is they've got all this technical data and they've got all this experience and they've got all these measures and tools and charts and figures, but really they're sitting there going like, shit, what do we do? Like, I feel sorry for anybody who has to make these decisions because
you throw
they don't know what they're
war in
doing.
it. Here's a war for you, by the way. Here's a little war for you on top of the pandemic you're dealing with.
You know, they
asked who's important, the worker, the mortgagee, the, you know, the government, like whose back do they really have right now?
I don't think they have honestly anyone's back, but just looking at inflation and saying, but I you know, you're hurting those people at the same time that you say you're trying to help, and just getting people to curb spending is, I don't know, part of me feels like they're not doing it the correct way, and you know, like just a blunt instrument when they're using a shotgun when they need a sniper. But
why is it part of the system? Why does it work this way? Why is there this company that does this? Why can't it just be like, you're not allowed to lend money for more than 3% or you will kill you? Everybody just keep it at 3%. Okay.
There is one way of like artificially suppressing the market. Like they tried it with the stress test, but there was loopholes with it, right? You know, you could easily you probably just need different interest rates for different markets or different industries, right? Saying like, well, housing market in Toronto probably needs like 4 or 5%, but
yeah, I said that before, and people said I was a complete
they
idiot
got
for saying that.
The luxury tax.
I think
the new
TK
luxury
was
tax
one of them.
Is their tool right now, right?
I'm not saying it's the right answer or not. I'm just, you know, we're here just spitballing, but you know, it's a very difficult situation, and I think about Jim Grant. He writes this thing called Interest Rate Observer, and they asked him, "Oh, what would you do if you were the head of the central bank?" He goes, "Oh, first thing I would do is quit." So, you know, because there's people who just put in really shitty positions, right? And it's like,
yeah, why would you want to do that job?
I know, but it's tough because when we talk about rates, it's not like, oh, foreign buyer tax came in, and that's just like, if we think of this money and liquidity just like a flowing river. And if someone puts in October stress test, okay, well that's a pretty big hurdle in the way, but money just flows around it. Someone goes to a credit union, or they they pay off their car loan, and then that gets them the mortgage, and then they get back and they get the car loan again or something, something along those lines. There's avenues around it. Then they introduce a foreign buyer tax, and it's like, okay, well, there's still avenues around that too.
Municipal land transfer tax. That was what this was supposed to be, right?
Right.
Housing prices in Toronto, it was like going crazy. So they're like, we'll tax people more and it'll make them want to live in the 905 instead. That didn't work.
Right. So again, this is just another speed bump. It just water flows the other way. But when we talk about Bank of Canada's overnight lending rate, it's not like just a speed bump. It's a wall. It's like the Hoover Dam. Nothing gets through. This is the rate. You have to pay it. And the only way right now that I see that people are getting off on it are, like we mentioned earlier, are the static variables, where it's like, push the can down the road. We'll make your 30-year amortization 60 years, and you can just continue to pay interest only. And when renewal comes,
good luck.
We'll figure it out.
Good luck, man.
We'll cross that bridge when we get there.
Let's go back
Peter,
to that,
remember when you sold us this house and you said you'd help us when it was time for renewal? But aren't you guys going to start getting calls like that? I need help. I can't fucking refinance this thing, man.
Well, I'm not in the mortgage lending space. I'm a realtor, right? So
people were stress test at 5.25 or more. And so for them to say, like,
but they got co-signed by their mother and their father.
It doesn't matter. They were stress tests based on that income. And so that person knows that they need to be able to help out because they're on title. Because it doesn't make sense to be paying interest only. It doesn't make sense to amortize it for 1 billion years. That's a very, very small section of the market who literally something's changed since they got qualified in Q4 of 2021. And now all of a sudden they can't afford to pay those higher payments. Because if you were getting a mortgage, you should be qualified at whatever they need to amortize it. You should be going right into your 24, 25-year amortization. And if your payment jumps $1,000 because now you've got too much interest and not enough principal being paid off, just carry on with your new payments from there and a new static payment. But
the issue is the stress test does it in a point in time. You can, the day after your deal gets funded, you could go out and buy a Porsche or be as financially irresponsible as you want.
100%.
The other thing is,
or your dad could go bankrupt.
If we're talking co-signers, but let's just assume someone on their own, right? And they don't have co-signers. So also from that perspective, outside of being financially irresponsible, Royal Bank and what we talked about how they're handling these rate increases is they may be helping people in the short term, like TD. If you're well capitalized on your home, they're not going to change your payment. So you have to be prudent and responsible in saying, hey, like, I'm going to cut back on my spending, and I'm going to voluntarily up my payments on a monthly basis to make sure I keep up with the amortization. And you have to ask who, without being forced to do it, like, hey, if I don't force my kids to eat their broccoli, they're not going to eat it, and they're going to eat the French fries and they're going to move on. So like,
who's forcing people to do that?
So if you're not with a bank that's automatically changing your payments to keep you up to date with your amortization, how many people, if the banks sort of let you off the hook by just saying, just give us an extra $100 or an extra $2, or don't do anything at all, like maybe TD says they're doing? I don't know, because I haven't seen them implemented yet. But you're still leaving it in the consumer's hands, and at that point you're going to get a variation of outcomes.
I heard that yesterday actually from a mortgage broker, that it was only an extra $2
for RBC, right?
RBC, yeah.
I heard that as well too. I don't I don't know, because
someone told me this like very casually, and they were saying it's only $2, and then I was kind of going over like all the different scenarios, and he was telling me that there's cases where it's only $2 more, and I was like, this is unbelievable. But Darryl, this will be the new deferral cliff. Okay.
I probably,
absolutely. There's going to be
somebody's going to say
about.
In 3 years, when all these renewals come up from the static mortgages at 50 years amortization, that's when the market will crash. This is so good, right? I love it. We can't get
but
get enough of this stuff.
it's true, right? It goes from the
Yeah.
deferral cliff to the renewal cliff, and that's
The
it.
renewal cliff.
The renewal
Renewal.
cliff.
Dude,
We
put that
need
in the
something.
thumbnail, Daryl.
Renewal
That's
cliff.
perfect. Renewal cliff.
Right?
Doom, 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 doom. Oh my gosh. Like that's why I'm very like this, Peter, is like I'm very just like people have been telling me about the doom and gloom forever, and every single person's been wrong. So I figure if I just say that this will pass and that this won't be as bad as we all think and things will get better, I'll be right at least 9 out of 10 times. That's my theory
Well,
on all this. So whether I'm
yeah.
educated on it or not, I believe things will progress eventually.
There's a segment of the market that disagrees with that. All the people that got burned, right? All the people that got burned are like, you know what? It was fucking real for me. But it's not that big a segment, but they affect the market a great deal because they have to take the hit and bring down the price for the area, right?
They got to be the bag holders. But from our perspective, and Darryl has, like, going back 20 years, realistically, you're saying, hey, you told the story about 08 and getting burned, right? Now, I don't know the exact details, but we went on a pretty good run right after that. You know what I mean? And not took like 5-6 years, like within a couple of years,
10 months.
10 months, people, like, we weren't the US within, let's say, a year after, let's say 08. And I just started in the trade at that time, so I don't have a lot of experience at that point. But from that point, we shot up. We looked at 2017. Well, in some of the hardest hit areas, like I'm talking York region, where a lot of the speculative activity happened. Okay, well, within 2020, Toronto was about 18 months. We were about 24. If we came into like 2020, we ramped up again, and even before, like the Q1 before the lockdown in 2020, we were gangbusters. Like, people putting offers on day one. Like, if you were stupid enough not to hold back offers, like, you were getting an offer on day one, not knowing, because it just hit you like a ton of bricks between late 2019 and first 2.5 months of 2020.
January, February 2020.
Yeah, exactly. So, like, we don't have, and I think the people who are talking a lot of doom and gloom are the 50-year-olds, because they realized they saw their home got cut in half in 89, 90 and didn't recover for a decade. So I think it's a lot of those people, because we don't have any immediate experience.
They're older than 50. They're like 60s, 70s now.
Yeah, pretty much. So, from our perspective, we don't have that experience, because our own experience is, okay, 25-30% drop. We'll see in 3 years when the market rips again and we're making money, right? Because that's our longest experience in heavily speculative areas, like Markham, Stouffville, Vaughan, Richmond Hill, all these areas.
Everywhere.
Big hits. They all took big hits, but by within 24 to 30 months, they were up and at it, and everybody was over water, no problem, right? Like the people who bought at the peak, it took them 2 years, give or take, to get back to normal.
Inflation wasn't the same. I think at least in 2008, inflation wasn't really the issue so much as it was the whole banking system just disintegrated overnight and liquidity dried up completely, like all of a sudden. And it wasn't all of a sudden. Like, you heard the stories, you heard that, you felt it coming, and some people could get out. I personally couldn't get out quick enough because the market just died as I had finished my projects. But, like, again, it's like, no matter when or what, like, there's a segment that's so big that is going to get really hurt right now, regardless. It doesn't matter. Like, they're just going to get destroyed, and they're going to be a small part of the market, but their house will be a new comp on a street for an area, and that screws everybody else in the process. That's the real problem. But, like, the whole thing is, how long in the Twitter space were we talking about, like, why don't they just start raising rates like a quarter point now? Like, what the hell's going on? What are they waiting for? And we don't have to have this level of destruction, do we? Like, even within the system, if they would just kind of like stay in the neutral rate, maybe that's not supposed to be, destructive or
Stimulative.
Like, why don't we just stay there? and just fucking hit the brake, hit the gas, hit the brake, hit the gas. And like, maybe you're a little fucked. You got 4% instead of 3, but you're always somewhere between 3 and 4. And, you know, if we're overheating, it's closer to 4. I don't know. It seems so crazy that it's like fucking to the floor at 0% for so long. And then boom, all of a sudden we're at 6%. And it's all on it's all on the heels of this guy who we're all supposed to believe, who's running the whole show, says, like, don't worry, go borrow money. Like, this thing, we're going to be dealing with this for a while, at least until 2023. Like, literally, that's what he said. So all these people are like, I'm going, let's go. Now, nobody knew a oh, no, did he say that after the pandemic?
It was July 2020.
Right. Like, what the fuck is going on? And we're all just sitting here going, okay, like, let's adjust things. Let's figure out how to adjust to this. Why don't we burn that building?
At that time.
It's crazy.
Yeah, at the time, their biggest fear wasn't inflation; it was deflation. That's why they just slammed the brakes on rates and dropped them down. Right, that's their biggest fear. But now, like I said, the only thing that's changed is CPI is at numbers that, for an extended period of time. I think maybe in 2008 in the States it was high. It was just as high, but it melted away. So again, the only difference is we have, for over a year now, we're looking at persistent and consistent high inflation prints. And everyone's freaking out, but again, smart guy Ben Rabideau says when the inflation story changes to the recession story, that's when they'll pivot.
That's when they'll pivot.
And that's when they'll pause. That's you know, again, someone else, and again, I watch a lot, I read a lot on this stuff, and it just someone else mentioned if they're using CPI and employment as their indicators, well, those are lagging, but
right.
Apparently, interest rates are leading indicators. So they're trying to determine, and maybe this is why they're always behind the curve, because they're using a leading indicator. They're judging a leading indicator through lagging indicators. And I don't know. I don't know if
I looked up some immigration numbers. I looked up some immigration numbers today or yesterday, and I was just trying to figure out like a few different points. And the best information I can get was 2016.
Right.
That's how far behind they still were.
Oh yeah.
No, there's some, I know there's some, but some of the numbers, some of the reports I was looking for, they were like still years behind, because they're just like, there's only so much information that they process, and it takes time for them.
That was the last census. That was the last census that was done, I think.
I think they just did one.
Maybe they just did
2020. But
that's going to take them 16 years to compile the data and process it properly.
I'm just saying some data is like that, where they really just don't have the means or the capabilities of creating it, you know, in a more immediate fashion, right? So
I think they kind of do. They're just not using it. I mean, God, it's not that difficult, is it? I mean, everybody's got a license, like.
Well, we're talking about it from like down here. They're looking at about it from up here. By the time
they need to come down here, bro, and see what's going on in the streets, because they don't have a clue. I waited today. Okay, on a property that I have, we are that I got a tax, not a tax bill, like the certificate that says what your outstanding balance is, and it was supposed to be 0, but it was like there was a month missing. And it just turned out that my tenant hadn't paid it to the right account, but I had to wait on the phone for like 3 hours and 15 minutes this morning just to get a human to discuss this with them. And they couldn't actually help me after that whole thing. But like, this is how our system works. So like, if little things like that work so poorly, I mean, I don't think it gets better the higher up it goes. I think it actually gets worse, doesn't it?
You're asking someone who has no experience with what's going up there. I think that they're privy to a lot of information, but how they interpret it and how they work with it is, I don't know.
Anybody's
that's
guess.
why
political.
People tune into YouTube and Twitter for the most up-to-date information. I'm not saying that we're the best sources out there. There's plenty of people out there who know, but where else are you going to go and get more up-to-date information on what's going on in the market and what people are doing? Right? You want to hear from the realtors, you want to hear from developers, you want to hear from politicians, you know, the Twitter spaces. You guys have had some great people on there. Some of the guests that we have on our show, some of the other people who make videos and stuff like that. Like, it really is leading information. That's what it is. That's the attraction to it. And it's unbiased.
Hopefully, yeah.
Unless it's a real estate agent. Jeez.
Then you don't know
According-
what the hell's
according
going to
to
come
all
out
the
of their
comments
mouth.
we're getting is no one believes a word that I say, and Darryl is a realtor, guilty by association.
Even
That's
Peter
fine.
called me a builder. I haven't built anything and I don't even know how long. But there's a grand misconception as to what I am. And it's probably better
You like
off
the
for everybody.
mysterious, yeah.
I'm mysterious.
Well, I know
Well,
you used to build. Yeah.
I definitely used to build and I learned my lesson. That's for sure. I learned really big, hard lessons the worst way possible. But I learned. That's the good thing. I learned.
Peter, I want to give you a little plug here. So where are you located? Where's your office?
Well, I'm with my team is Compass Realty Group. That's Compass with a K. Just because my last name is too long to put in there. It's Kiriazopoulos, so we just went with K.
I pronounced that properly, by the way, and Daryl didn't.
That's
just
okay.
I
It's
have
all good. Don't
evidence.
And we
worry.
have it on
I have
tape.
evidence.
We have it
That's
on
right.
tape.
It's okay.
Exactly.
So, you know what? Sometimes even I get it wrong, so it's all right.
TK, we had the wrong Kiriazopoulos on the show. I'll tell you, I was on their website and I think we need to have his wife on the show next time.
Yeah,
Oh,
she's an agent too.
Yeah,
She's
my
a
wife's an
lovely,
agent.
lovely looking
Awesome.
lady.
Oh,
And his
thank you, thank
kids,
you.
holy cow, your kids are beautiful. Wow.
Thank you very much.
Very,
Yeah, so
very cute.
we're at compassrealtygroup.ca. We deal primarily York Region and Toronto and parts of Durham. But aside from that, there's a team of 4 of us, and that's pretty much it. And then on Twitter, I'm Peter of Record instead of Broker of Record. So make sure everything I say is I have to default back to it and take responsibility for it.
There you go.
Awesome. Yeah.
Great.
Check him out. Anybody listening, check out Peter, check out his website, his social, smart guy, and great contact. But I appreciate it, Peter. You've been great today.
Yeah, much appreciated, guys. I really
Awesome.
enjoyed this.
Thank you so much.